Welcome to Poor Millionaires. Today's guest is Clive Thompson. Clive is an investment content creator and educator, having retired from a long and distinguished career in wealth management. He's a big advocate of holding gold and other tangible assets in a portfolio as a hedge against fiat currency debasement, and we'll be talking about the role of gold in creating a resilient portfolio that can withstand the looming debt crisis. Poor Millionaires is the show for people with investable wealth of $1 to $20 million. We strive to educate, connect, and inspire, to give you the tools you need to thrive and secure lasting prosperity for yourself and for your family. PoorMillionaires.com. Invest with ambition. This podcast is for educational purposes only. The information does not constitute financial advice or recommendation and should not be considered as such. Value of investments and any income derived from them can fall as well as rise, and you may not get back the original amount you invested. Clive Thompson, welcome to the show.
Thank you, James, and I appreciate you having me.
Good to have you. So, Clive, your background is as a wealth manager, mostly in Switzerland, I believe. During the course of your career, you've dealt with many people who we would define as poor millionaires. So that's the investable net worth of $1 to $20 million sort of ballpark, which makes you pretty much uniquely positioned to talk about the challenges and the issues faced by this cohort of people. Just give us a bit of an insight into your career, what the key takeaways were, and just give us a bit of your analysis in terms of the investing behaviour of this group of people and where they might sort of go wrong and where they go right.
Well, I think the vast majority of people that I dealt with were self-made millionaires. They had sold businesses, and typically the amount of money they had spare to invest after their other assets like homes and things would be in the range of what you said, 1 to 25 million. Of course, we did have the odd client with less than $1 million, and I had the odd client with a little bit more than $1 million, but I never had these sort of $200, $500 million clients.
But what we call ultra high net worth individuals.
Yeah. Broadly speaking, these were people who wanted someone to help them with the management of their wealth. It was to do with residence, it was to do with taxes, it was to do with investments. And of course, I worked in a private bank, wealth management bank, and so the thing we actually sold was the investment management services. But at the end of the day, the clients expected all the other services which go with it, such as tax advice and how to structure their things, trusts and offshore companies and those sort of things. I always worked for very well-known, highly reputable banks. So unlike what a lot of people think, people think that Switzerland was full of numbered accounts and secretive accounts which weren't tax-paid. To tell the truth, I never really encountered that in my life. I mean, I can think of one occasion, if I go back 40 odd years ago, something like that, when somebody came in with a suitcase full of cash. And it was the only occasion in my entire career I saw something like that. And I went to see my boss and I said, "What do I do with this?" And he said, "There's no way I'm sending those banknotes back to America with the name of our bank, rubber bands around them, get rid of the client." And that's what we did. So it was never, ever in my career, at least in the banks I worked for, anything like you see in the James Bond novels with these numbered accounts. Of course, we had numbered accounts, but they weren't secretive. We supplied all the clients with a tax report every year, and you got a lot of inquiries back saying, why is it showing this for tax? I don't think I should pay tax on that. And so, it wasn't at all the picture which was painted. Of course, we did have, about 15 odd years ago, 20 years ago, the proposals to bring in this global reporting for tax purposes. So right now, as you probably know, wherever you bank, doesn't matter where in the world you bank, every bank reports to every other country's tax authorities all of your income, all of your assets, and all of your gains. And so this was coming in. I started talking to my clients. I'd say, "I hope you're all paying your taxes." And then that dialogue was happening. And if anybody wasn't, I'm pretty sure they were, but if anybody wasn't, I'm quite sure that they started quietly putting it on their tax return. So by the time it came in some years later, there were no repercussions at all.
So you more recently you've started to post videos on YouTube. You do a lot of online educational content around investing. What prompted you to start doing that?
I think what I discovered was the vast majority of my clients, whilst they were rich, they were newly made millionaires, having sold their business, and honestly said they all started poor. One of my clients, he's long dead. He arrived on a boat from Cyprus at the time of the Turkish invasion, and he started washing dishes, not speaking any English. And he ended his life being a major hotelier and with, let's just say, managed to sell out for quite a lot of millions to Queensboat Hotels, who subsequently went bust. But that was one example. But many of them, they started in a job and found that their employer wasn't doing the job well enough, and then they started out on their own doing it better, and ultimately they could sell their business for a huge price. But they didn't know about investments because they never had any money. All their money was in the business. One day they got all this money, they put it in a bank, and the bank says, "Hey, you've got all this money. Would you like us to help you with that?" And so I discovered I was spending most of my time visiting the clients, talking to them about the benefits of investing, of not just leaving it on deposit. And it quickly became a theme for me, and we're talking back here 20, 30 years ago, that if you just leave your money on deposit, you're going to earn interest, you're going to pay a lot of tax, and at the end of the day, the governments of this world, we're talking UK in this case, are printing the money faster than the interest they're paying on it. So this is the reason your house is worth 10 times what it was 10 years ago. It's the reason that everything you buy is worth a lot more money. And I kind of got into that theme, and it was pretty much a theme of mine, and more clients started to invest the money. So by the time I retired, I would say even 20 years before I retired, the vast majority of clients had their money fully invested. Now, that didn't mean to say it was fully invested in equities, but equities was my thing. I mean, I very much enjoyed equities and gold, but it was fully invested in a diversified portfolio of different types of investments. And that was obviously what I would teach and what the bank wanted us to teach, that you don't put all the eggs in one basket, you spread it around in lots of different things, because even though I had a view, the bank has a view as to what's going to happen next year, you have your themes, it doesn't mean to say things are going to work out the way you expect. And to tell the truth, they very rarely did.
So a lot of your content focuses on gold as an asset class. I know you look at other things too, but we're here to talk about gold today. What is it that attracts you to gold as an asset class, and what are the potential benefits for poor millionaires looking to sort of diversify into that asset class?
Well, I think the first thing to say, it is an asset, and therefore, if you could diversify and have some gold in your portfolio, you will have another layer of protection. And we mustn't forget that gold is nobody's liability. Everything else you own in your portfolio, you're beholden to what somebody else does. So you might own shares in the best company in the world, but if the directors suddenly turn out to be crooks, your company could be worthless. You might be holding money in a top bank, but if the bank suddenly decides that you're a friend of Putin and they have to freeze your account, you can't get it. You don't know what happens tomorrow. So there's a lot to be said for having some assets where there's no intermediary between you and the asset, no custodian. Your own home would be something where there's no custodian. But if you own a fund, you've got that custodian in between you and the money. And that always is, it's an extra leverage. Now, of course, I was working in a bank, so I wasn't preaching to own your own assets in your own name. The bank would have to make money by actually having the money in the bank. But at the end of the day, gold is a valid diversification, and it will probably behave it'd be not totally correlated with the rest of your investments. But perhaps I should make clear, I'm not a gold-only man. The reason you've heard me talk about gold a lot is the very, very first time I was invited onto somebody's YouTube channel, he wanted to talk about gold, and kind of that sort of spiraled a bit.
You can name for yourself.
But I have been investing in gold myself all my life. My first exposure to gold came when I was probably around, I'm guessing 5 years old, or maybe 6 years old. I went to visit my grandfather's house twice with my mother, and he had some friends around, and he put on the table in front of me the first time I went, for his amusement and his friends' amusement. He put on the table in front of me a 6-penny bar of chocolate, Cadbury's bar chocolate, and a £1 note. And he said, "Clive, which one do you want? Being 5 years old, I took the bar of chocolate, and all his friends burst out laughing because the sixpenny bar of chocolate could have bought, the £1 note could have bought 40 bars of chocolate. There were, by the way, 240 pennies in the pound back then. So it was highly amusing to all his friends that I picked the bar of chocolate when I could have bought 40 bars of chocolate with a £1 note. And a year later, he tried the same trick on me with his friends, and he put on the table the bar of chocolate, the £1 note, and this time a gold sovereign, which is a £1 coin from the UK. But it wasn't in circulation. It was these coins weren't minted at the time, but they were old gold sovereigns. But it still was a £1 coin. And he said, "Clive, which one are you going to take? You're going to take the bar of chocolate, the £1 note, or the £1 coin, the sovereign, the gold coin?" And being a smart kid by the age of 6, I now took the £1 note. Now, his friends that time didn't burst out laughing because nobody in the room, apart from my granddad, knew what a sovereign was. My granddad worked for HMRC, the Inland Revenue or the IRS in the UK, the USA. So he worked for the taxman, so he knew about assets. But nobody else in the room knew about gold or anything like that. So there was no laughter. So then my granddad tried to explain to me and everybody in the room why gold was more valuable than the piece of paper. And I don't know what he said, but I suppose, thinking back on it, he must have been explaining what's called Gresham's Law, that people hang on to the more valuable asset and pay with the worthless asset, the debased coin, or in this case, the debased paper.
Bad money drives out good, right? Is that?
That's right. The bad money drives out the good money. That's Gresham's Law. So I got to the age of about 14 years old, and at some point my grandfather gave me this gold sovereign, and he said, "Clive, you keep this, don't tell anybody, and hang on to it forever." Okay, that's fine. I put it in my pocket and kind of forgot about it. But many years later, I was at the age of 18, I was working in the City of London and working in a bank. And just down the road from us, there was a shop which dealt in gold and silver called Sharps Pixley. They're still around today, it's well known. And I thought I'd take my sovereign along, my £1 coin along to Sharps Pixley and see what it was worth. So I took this gold in, and Sharps Pixley said, well, and I can't remember the figures, but they said something like, we'll give you £15 for it, or £10 for it, or we'll sell you another one for £20 or £25. And I didn't like the price they were going to sell it to me, or the price they'd buy it from me, so I didn't do any business with them. But I was rather fascinated by the fact that this £1 coin apparently was now worth £15. And I think when my grandfather had shown it me the first time, it was probably only worth £3, but I wouldn't have known that. So I thought, wow, £1 coin worth £50. I'll go and get some more of those. So I start, and I know, and don't forget, I'm a thicko 18-year-old who's got no knowledge of money. It's not like today where you can go look things up on the internet. There was no internet back in 1975. So I took out some £1 notes and started walking around all the banks, Lloyds Bank, Barclays Bank, and so forth, seeing if the cashiers had any sovereigns they'd change my £1 notes for, and of course they didn't. I mean, there was no £1 coin at all in the UK back then. You had the well, I used to call it a shilling. It's now called 10p, but or it's 5p. I think it's 5p is a shilling. Anyway, long and short of it was I quickly learned that effectively what is Gresham's Law. Nobody's going to give me a gold coin, a £10 gold coin for the face value of a pound. So as I started to save money a little bit, I started to go back to Sharps Pixley from time to time and buy an odd gold coin. I ended up buying Krugerrands. They were very cheap back in those days. You could get them for, I think by the time I started buying the first ones, it was probably £150 or £100 or something like that. It was not expensive.
African 1 ounce gold coin, isn't it?
Yeah, the Krugerrands are 1 ounce solid gold coin. They were the first. South Africa was the first country to start producing 1 ounce coins en masse. So they always had Krugerrands they could sell you. And over the years, I bought a lot of them. But also I realized that the gold price, if you took a longer term view, just seemed to keep going up. I mean, it was when I I remember at some point in the 80s, it was like £250, and then I watched it go up to £800, and I think it was doing obviously rocketing up in price in dollars as well. And I started to study it. I was writing articles on it, for my clients, saying perhaps you should put some gold in your portfolio. And the way we do it back then, we're talking about the 1980s, would be you'd buy a physical gold bar of 1 kilogram, and it would be deposited in the bank's safe, but it would also appear on the client's portfolio, so they could see it, and they could walk into the bank, and you still can today in Switzerland. You can walk into the bank and withdraw your gold bar. So a client's portfolio would show cash, time deposits, bonds, equities, physical gold. You say three gold bars, 99.99 fine of 1 kilogram. And so I always had gold. And back then, if we talk about the 1980s, the exposure to gold was typically in a portfolio, typically around 5%. But as the years went,
than it is now, right?
yeah, yep, that's right. As the years went by, we went from 1990 to the year 2000, very roughly, when gold was literally doing nothing. It didn't do anything. The stock market was going up, but the gold price was doing nothing. So what happened anyway, what was happening was this: the gold exposure in portfolios was falling because other assets were going up, and banks were reducing their exposure, and it went down to 3%, then 2%, then 1%, and eventually
Gordon Brown
the bank
sold all the gold of the UK right at the bottom of the market. Yeah,
exactly. So eventually, the gold exposure in portfolios kind of ended up as a recommendation of zero. Now, later on, in later years, from sort of 2020 onwards, we had a leeway as a wealth manager to have more than the recommended amount of any asset or less. You had a 5% leeway. So the official recommendation was zero. So I went to the maximum leeway allowed, which was 5%. So I said to all my clients, you should have some gold in your portfolio. They all had 5%. And of course, that was very good timing. But I'm seeing now that gold, if you look at the banks, we're starting to see recommendations coming out of banks saying, yes, you should have some gold, whether it's 1%, 2%, 3%, or 4%, or 5%, that depends on the bank. But there's still a lot of banks which haven't yet got around to saying gold is part of our asset allocation. But globally, I think the asset allocation to gold is probably, I'm guessing here, you can't know, but I'm thinking it's probably below 1%. And I'm thinking that it will probably go up over the years which come. So why am I so bullish about gold at the moment? And I want to stress it's not the only thing I'm bullish about. I'm bullish about a lot of things. I'm going to put it a different way. I'm negative about one thing, and that's about the fiat paper currency and government bonds. So when you're negative about that one thing, you've got to be bullish about everything else. But I think gold has a rather unique. It's a rather unique situation now that governments around the world are trying to increase their exposure to gold because of what's happening to the dollar and because of what's happening to the U.S. Treasuries. We've seen a couple of years ago when Russia invaded Ukraine, the dollar was weaponized. And all around that basically said your reserves are frozen, and now they're talking about even stealing the reserves to pay for give it to Ukraine. So all around the world, there's countries who are thinking, well, we're not enemies of America, but we're not their best friend either. What if something goes wrong in our relations? Do we really need to have quite as many treasuries, US treasuries? Shouldn't we have something else which is not the liability of the United States? So we're seeing now, last year, the year before, the last couple of years, record buying of gold by central banks, and they're building up the reserves. Now, all around the world, these central banks have much, much less gold than the United States, at least according to the official numbers. Now, I know some people are going to put in your comments, but China's been secretly acquiring gold. They've got tons and tons they've not told anybody about. Well, maybe they do, but officially, they've got a tiny, tiny fraction of what the United States has, yet it's a bigger country. So we see, according to the official numbers, that the Chinese are buying every month, month after month. They're acquiring some. They're doing it slowly but surely, and I guess they're very careful buyers. So they probably buy it on a bad day, and they don't. There's been no sign of any selling. So we've got the central banks buying. We don't yet have much evidence of private individuals buying, and we'd spot that when the amount of gold going into the ETFs, the exchange traded funds, which holds physical gold, when the quantities in terms of tons starts to rise. Now, the value of these ETFs have been rising because the price of gold has been rising, but the number of tons isn't really moving. And we'd only need 1% of, let's say, NVIDIA or 1% of the Mag 7 to go into gold, and it would drive the gold price massively higher than it is at the moment, because the gold market is a very small market compared with the value of the stock markets or the bond market. It's tiny. So that's the reason I don't think much is going into gold at the moment. But people are changing their attitudes, and now we're seeing, with the latest debacle, I suppose I could call it, over tariffs, where countries are being accused of being the enemy of America because they sold their goods too cheaply to America. What an act of aggression! And countries like Canada, who are always best friends with America, so they say, "What? You hate us because we sold our goods cheaply to you? We're not cheating you." But suddenly you've got this spat, and now, and of course, Europe is retaliating as well. So we've got this spat going on between America and the rest of the world, and some countries are caving in and saying, "Tax us what you like, and we'll let you sell everything you want in, let's say, the UK, free of charge." But other countries are saying, well, if you want to punish us, we'll punish you. So we've got this trade war going on, which once again makes people think, do I want to hold treasuries in quite the same quantities as I used to hold them? And last but not least, we've had the suggestion, and it's been said by the president, that perhaps all these foreign countries, if they want the Americans to be nice to them, they should show loyalty to the dollar and to the treasury market. So that's what they're talking about is issuing 100-year bonds at a very low rate of interest as the price to pay to be friends with America. Well, that's going to be a particularly bad investment. Of course, from an accounting point of view, at a central bank, let's say in the UK or Europe or anywhere else, it won't look bad. It'll still look like $100. But from an investment point of view, a 100-year bond with a low interest rate is worth almost nothing.
So we've got a very bullish backdrop there for gold in terms of the outlook. I want to move on to talking about how the fiat monetary system plays into that, and also the potential for a gold revaluation a bit later on. But if we can just go back to gold as an asset class and the nature of gold, because some people talk about it as an inflation hedge. You mentioned the fact that it doesn't have a counterparty problem. So other people talk about it as crisis insurance. I think John Maynard Keynes referred to it as a barbarous relic. So how should we understand gold?
And I just add to that Warren Buffett called it a pet rock, which just sits there and looks at you.
It's a very divisive asset class, isn't it? Because you get people who absolutely love it, the gold bugs, and some of them just invest in gold and nothing else. And then you've got other people who just completely ignore it. So how should we understand it as poor millionaires? How does it really fit into our overall investing strategy?
So if we go back to the last century, before the 1930s, and perhaps before 1900 especially, everywhere in the world, gold was money. Money was gold, gold was money. It was one and the same thing. And provided you held a gold coin, it didn't really matter what was going on in the world. It was a gold coin, and over centuries, over thousands of years, it would buy you pretty much the same sort of thing from one millennia to the next millennia. But there were times when there were large influxes of gold and the gold supply increased, and that caused, at those moments in time, the price of other goods to rise in price because everybody had more money and there was a limited supply of everything, literally everything back then. So more gold would bid up the price. But later on, the world broke its ties with gold. The big event was in 1933, where it's actually 1934, but in 1933, President Roosevelt called in all the gold coins, bar a very small number, held by Americans and made it illegal for an American citizen to hold gold. And gold, at least as far as Americans, was no longer tied to gold. But the paper dollars were still circulating, and the paper dollars could still be changed by foreigners into gold at the official price, which in 1933 was $20.67. 1 year later, because America was leaking dollars left, right, and center for all kinds of reasons, he raised the price of gold, and that's how we see it today, from $20.67 to $35. That we see it, we express it like that. Back then, the legislation basically said the amount of gold in the dollar is reduced from so many grains of gold to a much lower grades of gold. It's basically a 61% devaluation of the dollar in one day, or it depends which way you do the math, but 41% or 61%, depending on whether you do it that way or that way. Yeah. It would have to go back up 61% to get back to where it was, or it dropped to 41% in value. Anyway, so he reduced the amount of gold in the dollar, even for foreigners. So if you cashed in your dollars, you couldn't get as much gold anymore. And then in 1971, Richard Nixon, seeing all the gold still draining out of America because they'd made the mistake of printing far too many dollars, and foreign central banks were seeing this and saying, hey, America can't pay us all, let's get our gold first. So they were handing in their dollars and saying, pay us. And as this gold was going out of the door, they realized they'd soon run out. So Richard Nixon closed the gold window and said, we're suspending temporarily the ability of anybody to convert their dollars into gold at the official price. And then, of course, the gold price took off. It was $35. It went, although they raised the official price to $42.22, the gold price took off to $100, $150 and just went north forever. And what we've seen since then is two things. The main thing in the early years was non-stop printing of money. So this money would be printing, the money supply was be getting bigger and bigger, and as the money supply got bigger, we had this amazing thing coming in, which had been happening since they came off the gold standard in the 1930s, but became a much bigger thing in the 1970s, called inflation. So inflation, in the old sense, was an inflation of the money supply. Inflation of the money supply. And the symptom of inflation was rising prices.
Now we talk about it as purely as rising prices, don't we?
Yeah, it's become a word which means
the money supply has gone up 10% plus in 1 year.
but exactly. But there's something which has changed in the last decade or so, particularly since the COVID pandemic. And what's changed is there's another component which is increasing the mass monetaire, the amount of money which is available to people, and that is government debt. And I think people still sort of say, oh, inflation's all to do with the money supply, but it's not the money supply anymore. It's basically everything which you can turn into cash. But in particular, we're going to take the treasury market. So the government debt has been increasing, and last year it increased by, I think, this year it's 6.7% more than it was the year before. So what happens when the government has a deficit? It's spent money it doesn't have, so it then borrows that money. And when it borrows the money, the government gets poorer every year, year after year after year. So that's the government debt getting bigger and bigger and bigger. Government's getting poorer. But as the government gets poorer, someone else gets richer because they're spending that money. And that money goes into the hands of social services, Medicare, all kinds of things. It goes into the hands of all sorts of, so the army, it doesn't matter, but it gets spent. And those people who get it spend it, and gradually the money gravitates up towards the wealth gatherers. The wealth gatherers are those, you can call them capitalists if you like, but whatever they are, they're the people who own factories, who own businesses, the people who are doing well because they've found a way to have a more profitable business than just working for somebody else. So the wealth is moving its way up, and those people have surplus wealth, but they're not going to buy any more pizzas. They're not going to buy any more baked beans. They only want one iPhone. So even if there's now more people on the planet who can afford all these wonderful consumer goods, we must know that these consumer goods are not in the kind of limited supply they were back in the 1930s and before that. if demand increases, supply can be dynamically increased to meet that demand at no extra cost. You don't say, oh, sorry, there's only a million iPhones in the world and a billion people want it, so we'll see who's got the most money. But there are things which are in limited supply. There's only so many shares of Nvidia. There's only so many shares of Microsoft. There's only so many houses or penthouse flats in New York. So the things which are in limited supply are seeing an ever increasing number of people who've got the money and can afford them. And one of the things which is in limited supply is, of course, gold as well. And as the government gets poorer, there's more and more people can afford to buy gold. There's more and more people at today's price, or more and more people can afford an apartment in a penthouse in New York. More and more people can afford a luxury villa by the sea. So the prices of these limited supply assets are squeezed higher, and that explains to everybody why probably the home they're living in is 10 or 20 or maybe 100 times the price it was 50 years ago. It's not that the home is bigger, it's that the money is more plentiful, there's more of it. Not only money in the bank, and that's the money supply, but also the debt, the government, the treasuries, the treasury bills and notes that people can turn into cash at an instant. So if I'm a wealthy person, I might be storing up a huge amount of money in treasury bills, and if I want to buy something, well, I can turn it back into cash with the press of a button. And there's more of that than there ever has been. So when we look at the increasing money supply, I think we're wrong to talk about the inflation of money supply as influencing the prices of retail goods. First of all, nothing influences the price of retail goods anymore. It's only the limited supply goods which are influenced by more money supply. But what is the money supply? It's not just the money in circulation, it's everything which can be turned into money very, very quickly. And that everything is getting bigger and bigger and very fast.
So what's the potential for a change in the monetary system? Because a lot of people believe we're approaching the end of this current phase and we're going into something new. I think you've talked about that in some of your other videos. And feeding into that, what is the potential for another revaluation of gold in the US by the US government, and what are the implications of that for gold and gold investors?
Well, first of all, the levels of debt cannot continue at the pace they're going. And we've heard a lot of very important people who know what they're talking about say that as well. So it's not just me saying it. Janet Yellen has said it when she was Secretary of the Treasury. Jerome Powell has said it. And there have been many, many more people who know what they're talking about and important economic positions who said, this is unsustainable. Something has to be done. But it looks like nothing is going to be done at the moment. At least we don't. I'll come to that. There may be something about to happen, but something has to be done. And if something is not done, there will be a crisis. And the Congressional Budget Office is saying that. The director of the Congressional Budget Office has also said this is absolutely unsustainable. Not exactly his words, but basically, it's quite crystal clear. It goes on forever. Now, one of the biggest problems, and I'm going to use the US as an example, but this applies around the world, at least to the Western governments. One of the biggest problems we got is interest on that debt. As the debt gets larger, the interest burden gets larger too. Now, that wouldn't be so much a problem if the economy was expanding at the same rate as the debt, but it's not. The economy is expanding at a rate of 1%, 2%, or 3%. It's about 1% at the moment. And if it goes into a recession, it'll be a negative expansion. But positive or negative expansion of the GDP, that's the economy, the level of government debt is rising by a very high percentage. As I said, it's about 6.7% rise this year. So as the debt rises faster than GDP, it means that the amount of interest the government's paying on that debt as a percentage of the gross domestic product is increasing at a faster and faster pace. And it's increasing at a faster and faster pace compared with the tax take of the government. So if we go back 3 years ago, the interest component of the US budget was about 8% of the amount it collected in taxes. This year, 3 years later, it's gone from 8% of the taxes to 18% of the taxes. And that's going to get a lot worse for two reasons. Firstly, because the debt is going to continue growing faster than the GDP, so it'll grow faster than the taxes they collect in. And the second reason is this. Since the 2008 global financial crisis, interest rates have been very low, typically in the range of 1% to 3%, very low. So the average borrowing cost of the United States, we can't know it exactly because it's impossible to work out, but it's probably in the range of about 1.5% to 2% on their existing debt. But that debt it has different maturity dates, but as it matures, they have to roll it over into new debt. So if you have a government bond which is yielding 1.5% maturing now, they have to go out and borrow the money. And interest rates today, if you borrow money in the bond market, are nearer to 5%. So what we've got is a decade and a half of low interest debt, which is maturing over the next decade and a half, which will have to be rolled over at an interest rate which is many times higher than the maturing debt. So that means that not only will the debt be increasing because of the increased amount of absolute debt, but also the interest rate being paid, or the amount being paid, will also be increasing because all that low interest rate maturing debt will have to be rolled over at higher interest rates. So you can see this 18% of tax take in terms of the cost to the government now is going to keep rising, certainly for many years to come. Now, there is a slight hope. Maybe they'll reduce the interest rates to zero. I say they'll reduce. It could so happen. It won't be the interest rate. It's not Jerome Powell who's going to reduce the interest rate to zero and say, here, you happy government, because the government can't borrow at zero. It borrows in the bond market, and the interest rates in the bond market are not particularly controlled by the Federal Reserve. In fact, we've seen interest rates in the United States come down. We've had 3 cuts in the interest rate, yet the yield on government bonds across the board for 10-year, 20-year bonds, 30-year bonds has all risen. So it's now costing the government more to roll over than when they started reducing interest rates. And I think as the debt gets bigger, there's going to be more and more people who say, you know what, if they can't pay, they won't pay. So that means that investors are going to demand an ever-increasing interest rate before they expand the amount of treasury bonds they hold in their portfolio. So if your neutral position would be to hold, 40% in treasury bonds, you're a pension fund, for example, and now you're at 45 and the government wants to borrow even more, at what point do you get indigestion and say, I won't do it anymore? Well, what's going to happen for you to keep buying is the price of the bonds you hold has got to go down, so you still only earn 40% in value terms, and the interest rate has got to go up, or the yield, in other words, to make it much more attractive. But the more that happens, the closer we get to a bond market crisis. And so it sounds like there's no solution, but there are potential solutions out there. And one of them, which is not particularly, well, it will affect the gold price, would be for the Federal Reserve to step in as buyer of government bonds of the last resort. So you get to a certain
We've kind of seen that happen before, haven't we, in previous crises?
Exactly. It happened in this is exactly what happened in the 2008 sovereign debt crisis. It also happened in the COVID crisis, when there were a lot of people being laid off and they had to fund the government so the government could pay everybody their furlough pay. And of course, it has happened in the past. I can't remember which year it was, I've forgotten now, but going back in history, there was, I think it was 1960s, the US government passed some legislation forcing the Federal Reserve to invest in government bonds. Oh, no, it was 1934. Basically, if you look at the legislation 1934, I don't think it was quite, you must buy government bonds, but I think it went something along the following lines. The Federal Reserve is now permitted to invest $2 billion into Treasury bonds. In other words, do it or else. But it was kind of you can read the legislation, but basically they did it. They did as they were told. So that could happen. We could have the Federal Reserve stepping in and buying these government bonds. But what does it buy with them with? Well, the Federal Reserve is a bank or a collection of banks, and it has a balance sheet. When you buy something, the asset side of the balance sheet, as far as the Federal Reserve is concerned, are the bonds you buy. But the liability side of the Federal Reserve balance sheet is the electronic money it prints. So when it buys government bonds, it'll obviously in the old days churn out the printing presses, but these days is electronic. They'll churn out electronic money and transfer that electronic money to the Treasury, whilst at the same time buying from the Treasury the bonds. Government debt goes up, government gets poorer, and in that kind of world, the Federal Reserve should rub its hands and say, thank you very much, we've just given you something which pays zero interest, i.e. cash, in return for you giving us something paying 4%, 5%. Nice new premises, Dolly Bird secretaries, new computers, executive lunch boardrooms, who knows? I'm being facetious here, but obviously it would be delightful for the Treasury to be making a lot more money than it was making in the past. Now, actually, the problem with that actually is that the Federal Reserve. It'd be nice for the Federal Reserve to be making a lot of money, but the problem is the Federal Reserve, by law, has to give everything it makes, bar a very tiny amount, to the Treasury. So I was a little bit facetious when they say they're making a ton of money. When the minute that the Federal Reserve makes money, that gets paid as a dividend every month to the Treasury.
Right.
They're not making money at the moment, by the way, but I won't go into that. But the other way, of course, or the way I just described, doesn't sound so good, because if the Federal Reserve is printing money and lending it to the government in return for these bonds, the government debt is still going up. But there is another way, and that is the gold which is held by the Treasury. Now, the government has held, I think it's 261.5 million ounces of gold since 1934, when it basically confiscated it from the Treasury, from the Federal Reserve. That gold on the Treasury's balance sheet is valued at $42.22 an ounce. So at that price, it's only worth $11 billion. Now, if they were to revalue that gold to a new official price, a higher price, they'd be booking a profit, but it wouldn't reduce the debt. The debt's still going to be there. Just turning gold, for saying, okay, the gold price isn't the official. The statutory price was $42. Now the statutory price is $15,000 or whatever it is. Doesn't produce any money out of thin air. The debt stays the same. But there is a magic trick they can play, and the magic trick is to repeat the magic trick they played in 1934 with the Federal Reserve. So what happened in 1934? The Federal Reserve had all the gold, and they took it off the Federal Reserve, giving them in exchange what's called gold certificates. Now, these gold certificates are not redeemable in gold, and they can't be cashed in for money either. But they're only worth, today, the official gold price of $42.22 an ounce, held by the Federal Reserve. The Treasury could redeem those gold certificates. It would cost them $11 billion to redeem them. That's what they're worth at $42.22. The Treasury could then revalue the gold price to, I'm going to say $15,000. I'll explain later why I get to that number, because some people say it should be a lot higher, and they're right. But I think 15,000 would be the step they should do. They revalue the gold to 15,000 and immediately sell the gold back to the Federal Reserve for cash, newly printed cash. So now the Federal Reserve owns all the gold and the Treasury's got the cash, reducing the debt. But then the Treasury and the government do what they did in 1934. They take that gold back off the Federal Reserve, giving them in exchange gold certificates. Gold certificates are not part of the government's debt. So now what's happened? They've got all this cash from the Federal Reserve. They've reduced their debt. They've turned their deficit for the current year into a massive profit, reduced the debt, and got their gold back and given the Federal Reserve something in exchange, exactly what the Federal Reserve had before, for exactly the same number of ounces of gold, except that this time it says it's worth $15,000, which is worth 3.9 trillion. That's how much they'd be getting in. So the Federal Reserve gets a certificate worth 3.9 trillion on its balance sheet as its asset for the cash it has issued to the Treasury. But unlike a Treasury issuing Treasury bonds, which is part of the debt, the gold certificates are not part of the debt of the Treasury at all. So in one fell swoop, the government gets in a lot of cash, makes a huge profit. It's a book profit, because the profit on the gold goes from $42 to $15,000. They keep all their gold. They've got surplus cash after paying for the current deficit, which is around 2 trillion this year. They got 1.9 trillion still to spend, which when some notes or bonds are maturing, they just pay off those. They don't have to roll it over at these higher interest rates. And suddenly there are less Treasury bonds and notes on the planet. The government debt's gone down. They're showing a nice surplus, and
against a debt of, or is it now about 37 trillion? It's
yes.
A profit of, what was it, about 4 trillion. It's not exactly a game changer, is it, against the total debt of 37 trillion?
No, exactly. They'd be issuing about it would increase the money supply, or the amount of money the government's got without increasing the debt by about 10% of the national debt anyway. But that's how much the national debt almost is going up every year anyway, because of I said 6.7, but it's obviously increasing at a faster pace. So it's going up by nearly 10% anyway. So it's not going to be a massive game changer as far as the world is concerned, but it does put the USA, at least for a year or so, into a better position. And it's going to be very stimulative to the US economy, because the money which is no longer in treasuries, don't forget the debt has gone down, the number of treasuries out there has gone down, the money which is not in treasuries has to go somewhere, and it will find its way into something probably productive.
So that's the key then. That's the key.
So
this.
what we'll get is a stimulation to the economy, lower government debt. They keep all their gold, and probably, although people think interest rates will go up, it's quite probable that interest rates will go down, because the tax take will be going up because of the stimulation to the economy, and furthermore, with less treasuries but the same demand out there because more people have the money, those yields, instead of sharply rising, will stop rising and probably go down, reducing the government's funding cost.
So
will it be inflationary? I don't think so.
This monetary sleight of hand for the everyday gold investor, then, because presumably they become fabulously wealthy, the gold's going to kind of multiply in price significantly, isn't it? So
we have to assume that for this to mean anything, there's got to be a bid under the gold at $15,000, and I'm assuming there would be, and that would make a lot of sense for the Treasury to be bidding for the gold. Now, we all know that there's an army of people who say there hasn't been an audit, perhaps the vaults are empty. Well, I'm not suggesting that, but there are people who say they'll be valuing cobwebs. It doesn't actually matter if they're valuing cobwebs, because all that matters is people believe it. But the real point here is, if they put a bid under the price of gold, there will be many sellers of gold who will hand that gold into the Treasury in exchange for $15,000, which they will then spend on other precious metals or equities or something rare. They're not going to spend it on more pizzas, because don't forget, the holders of all this gold are the wealthy at the end of the day. They're people who, they're your clients. They're people who've got 1 million to 20 million. The man in the street might have a gold coin. He'll be very, very happy that it's gone from 3,000 or 5,000 to 15,000. Of course, he'd be delighted. But most people,
in a sense, it's kind of like the gold is almost like the prime. It's the prime for the pump, isn't it? Almost, that sits beneath the entire system. And what you're saying is, it's kind of, if they prime that pump, they can stimulate the entire system for it.
That's right. You're pumping money into this system in a way which will be stimulative to the economy. It won't be inflationary, because, as I explained, that price of retail goods is not very much affected anymore by the amount of money in circulation. What's in the consumer price index is the supply can be expanded. It's not the old days where you had a limited supply of potatoes, you couldn't make any more. So that won't change. It won't change retail prices. The dollar might go a bit lower. Well, of course, Trump might be very happy with that, because it means with a lower dollar, Americans might buy less foreign goods and sell more goods abroad.
Feeds into his entire sort of repatriation of industry narrative, doesn't it, I guess?
I mean, maybe the whole world will be happy with that, because we all love to buy American goods, you know, whether it be iPhones or tractors, you know, Caterpillar tractors, doesn't matter. You know, we buy, look how much services we're buying out of America, you know, all the software, Netflix and Microsoft and all this stuff, we're buying everything. Dollar go down? Great. Save the whole world money. So, but I don't think it would go down a lot. I don't think the dollar would go down 40 or 50%. I think it might go down a little bit, because there's just more dollars out there. And as I said, it's going to be only 10% of the treasuries which exist. So it can't go down by more than 10% of that. And it's a much smaller percentage of US dollar assets. So I don't think it would have a great deal of effect on the dollar exchange rate, if just a little.
So I'm a poor millionaire. I've listened to all this. I'm convinced by it. I want to kind of increase my exposure to gold. The options to me are physical gold, ETFs, and then you've also got gold mining equities. So can we talk a bit about those options, and you know what your sure. analysis of the various options out there?
You know, I think first of all, everybody should own all of those, but the exact proportion you own depends, one, on your wealth, and two, your personal situation. So let's start with physical gold and silver. I use and silver coins. I think that everybody who can afford it should have some quantity in a place which is secure and where they can get to it quickly, because you never know when you might need to lay your hands on it. Now, we don't see that here in the Western countries. You know, we're not at war, we have a nice, safe situation. But throughout history, there have been periods when it would have been very useful to be able to grab your gold coins and run.
Nazi Germany.
So, and of course, we mustn't forget the kinds of situations with sanctions. You know, sorry, we saw that we've got a picture of you shaking hands with Kim Jong-un. You must be an enemy of the state, therefore everything you own is frozen. You know, so there's an argument to have something that they can't touch and have something within easy reach. Of course, you might be just a businessman with a vast empire, which could come crashing down. And, you know, when that happens, they can bankrupt you easily. You might be living in a country where when the husband's found guilty not guilty, faultive in a divorce situation, the wife gets the whole lot. So there are arguments to have stuff which only you can lay your hands on. So everyone should have some physical. I'm not going to say the quantity. I'm not going to say 1%, 10%, 5%. It doesn't matter. They should have something which is right for them. Obviously, there's security risks and inconveniences of having it on your own. And one of the biggest inconveniences of holding the physical metal is the frictional cost of going in and out. Because you'll discover that if you go to a coin dealer and try and buy a gold coin, let's say in dollars, he might say, I'll sell it to you for $3,550. And then you go back the next day to try and sell it to him, and he'll say, I'll only give you $3,500. And if it's silver, the spread will be a much bigger percentage than on gold. So there's a lot of frictional cost. So you don't want to have stuff that you're planning to sell as physical. If you think you might want to sell it one day, if you have your asset allocation, you want to rearrange your asset allocation from time to time, then it should be in a custodian where it can be easily bought and sold with a narrow spread. So, for example, if you have gold in an ETF, ETFs trade with bid-ask spreads of probably less than 0.1%, but certainly less than 1%. The spread between bid and ask is almost nothing. So you can dive in and out of a physically backed gold ETF very easily. And these physical gold ETFs are available in almost every country on the planet. You need to buy one which is appropriate to your jurisdiction. So if you're in Europe, you need to buy one which is called a UCITS. Actually, they don't call them, they call the physical backed ETFs, they call ETCs, exchange traded certificates in Europe. And in America, they're called exchange traded funds.
And is it also important to make sure that these ETFs are physically backed? Because some you can also come across some that are synthetic. Is that right?
I think I think it's better to have a physically backed ETF, because if you're buying gold, or you want to buy gold via an ETF, you're buying it because you believe in having the physical. And when you go into an ETF, the ETF itself is forced to buy exactly the amount of gold that you went in for. Of course, they've got millions of people going in and out all the time, but collectively, you're forcing them to buy an ETF. If you're going for a derivative type ETF where it's not physically backed, they're not going to change the gold price on you at all. So I think it's sensible to buy the physically backed ETFs. Then, of course, the other way to hold gold, you can actually ask, it depends on which country you bank, but certainly here in Switzerland, you could go to your bank and say, buy me gold. We have currency accounts called XAU, that's a currency, XAU, gold is a currency. So you can have dollars, yen, euros, Swiss francs, and XAU and XAG and XPT accounts. Those are gold, silver, platinum. Or you can say to your bank, and this is possible here in Switzerland, I can't speak for other countries, please buy me 4-kilogram bars. And then if one day you feel the worst is coming to the worst, you walk into your bank and say, hand them over. They'll want to know what you're doing with them for money laundering reasons. But if you say, I fear World War III and I want to have them in my house, that's a valid reason. If you say, I met a coke dealer down the road, he's got a stash of coke and wants to be paid in gold, they won't give it to you. But at the end of the day, you could buy the physical, or you could go for the gold mining shares. Now, that's gold in the ground. But the advantage of a gold mining company is that there's a very leveraged effect when the gold price goes up. And I'm talking theory, because it doesn't always happen exactly how I describe it. So in theory, if the gold price goes up by, let's say, 10%, the shares of a gold mining company should go up by more than 10%. And the reason for that, I'm going to explain it slowly for the benefit of those who are not used to this. And in practice, I found that most of my clients didn't understand it. Let's say a gold mining company has a cost of production of $2,000. In other words, every ounce of gold costs it $2,000 to dig it out of the ground. And it's been selling that gold for $3,000. Its profit is $1,000 an ounce. Now, let's suppose that the gold price then rises from $3,000 to $4,000. That's a rise of 33% in the price of gold. So the gold mining company is still digging the gold up at $2,000 an ounce, but instead of selling it for $3,000, it's now selling it for $4,000. So its profit goes from $1,000 an ounce to $2,000 an ounce. So its profit has gone up by 100%, where the gold price only went up by 33%. That's the leveraged effect on a gold mining share, or on the profits of a gold mining company, when the gold price goes up. Every time the gold price goes up, the profits of the gold mining company, provided its costs don't change, will go up by a higher percentage. All things being equal, we assume they produce the same from one year to the next. We assume their costs stay the same from one year to the next. No, those are not things which are necessarily true. So you have to look at each gold mining company and say, what's going to happen to its production next year? Are they going to produce more, or are they going to produce less? And is the hole in the ground getting bigger, so they've got that much less to dig out? There's lots of other things which go into the equation, but
I guess all things being equal, it's the more marginal producers that can see the biggest increase in profits, isn't it? If they're a marginal producer, they've got the potential for operational leverage or operational gearing, as we call it, to kick into a much bigger extent, kind of thing.
And then, of course, even further down the scale, we've got the gold exploration companies who've found the gold. but it's not economic to dig it out at $3,000, but it will be economic at $4,000. Of course, there's another question there. How many years does it take to get the equipment and the resources in place to start digging? It could be a decade. But sometimes it can happen a lot faster than that, because the very large mining companies, the ones which are producing gold and selling it today, constantly want to renew their reserves. They want their reserves year after year to be creeping upwards, not downwards. So if the only thing they ever do is dig it out of the ground and sell it, what they've got left to dig out goes down. So what the big gold mining companies are doing all the time, apart from the fact they're looking for new gold everywhere, from time to time they find a company which is hunting for gold. They found the gold, but they don't have enough money to dig it out. And it is viable today to dig it out, but the company which has found it can't do it because they've not got the money. They'll buy the entire company and then supply the resources and equipment and manpower and everything else to start digging it out. So that big gold mining company can then say to its shareholders, last year we had 10 million ounces in the ground. This year we got 10.5 million ounces in the ground. And that's come about because they bought something which has got a lot of gold but hasn't yet been able to exploit it, an exploration company. So it's not to say that the exploration companies won't also profit. But of course, the magic trick here, if you want to, and I don't really recommend people doing this, but the magic trick, if you want to explore that, is to look for an exploration company which has found gold, is probably trying to raise cash because it would be viable to dig it out. And at the moment, they're struggling to raise that cash. And here's the important point, whose mine is very close to the mines of a large producer. Because the large producer is going, when it's looking for what to buy, it's going to favor a company which is not too far away, so it can move its equipment and its people around between its various locations without too much extra cost. And it's no good moving somebody from, let's say, somewhere in Canada to Ghana and moving tractors and stuff backwards and forwards. That's a difficult task. But if you've got two gold mines next to each other in Canada or Peru or wherever it is, it's quite easy to do that.
Yeah, I think the whole gold mining subject is something that I'd like to get you back on the show to talk about in future, if that's possible, Clive. Because I think there's a lot to dig into there. No pun intended.
I'll just tell your viewers the way to do it themselves. You don't need an expert like myself to do it for them. So I do get people writing to me saying, Clive, which one? There's a very easy tool. It's the artificial intelligence called Grok. That's the one which I tend to use myself. Just ask Grok to find you some gold mining companies which have found gold, which would be viable. They don't have the money and they're close to other big mining companies, and it will find it for you. And then you have to do a little bit of reading yourself. But at the end of the day, you'll have a list. If you want to go even deeper, there's another AI which is very good at this sort of stuff. It's called Manus AI, Manus AI. Yeah, it's a Chinese one. It's probably the best AI for very complicated tasks where you want current information. It's got to go out and look at lots of different websites, gather in the current information, put it all together and construct something. Whereas many other artificial intelligence have a database and they give you an answer based on their database, which might be very out of date and is not gathering the latest information from lots of different sources. So that would be but people could do it themselves by just asking artificial intelligence these days with the right question. It's useful if you are a good prompt engineer, and I'll just explain what a prompt engineer is. A prompt engineer is somebody who is familiar with giving the right kind of instructions to AI, and that doesn't mean to say find me some gold companies or how do I grow potatoes. That's a prompt, but a prompt can be several hundred lines long. It might start off you are an something like this. You are an expert in the gold mining industry. I'm a simple guy who wants to be exposed to gold mining shares. Please give me a report on the gold mining companies which attract blah, 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 blah. Give it to me in 10 lines because I can't read. I've only got 10 minutes to read. Something like that. But it could be 150 lines of, not code, simple English instructions, knowing how to, so you have to know how to give a good instruction, that's called a prompt, and which AI to use according to the task you want to achieve. So I'm jumping around depending on the tasks I'm achieving in AI. I'm using AI 20 to 50 times a day. I'm jumping around from different AIs because I know that different ones perform more satisfactorily in different tasks. It depends what I'm trying to achieve. Give you an example. One of the things I dislike about ChatGPT, if you give it too large a task, it just gives up on you, even though you're paying for it.
Yeah, yeah. Clive, I want to thank you for your time today, and I'd just like to also say I think what you're doing online is brilliant. I think people need this financial education. There's not enough out there, and there's such a dearth of financial education, especially when it comes to younger people. I think we should be teaching it in schools. So I think resources like yours are absolutely fantastic, and I wish you the best of luck with it. And I hope to get you back on the show at some point in future, if you'd be so kind, and we'll discuss some more of these topics in detail.
Well, thank you very much, James. I just encourage everybody who wants to learn about buying stocks. I've been buying stocks for 50 odd years now. I have a lot of videos. I'm putting them up all the time on YouTube about how to buy stocks. I only started about 2 months ago, but my audience is growing quite nicely. And if you want to know how I got to that $15,000 gold, there's a whole video about it, which I put up a couple of days ago. It's been very, very popular. It's got 2,500 comments already. So clearly people are very interested in the topic.
And just to finish off, if people want to find you on YouTube, they just search Clive Thompson. It's Thompson
just put in Clive Thompson, and I think I'll probably come up.
Good stuff. Thanks again to Clive for his time today. You can hear more from Clive by searching Clive Thompson with a P on YouTube. If you enjoyed the show, please do give us a like and share it with your network. And thanks for listening, everybody.